Hi, welcome to Bond Bytes, a daily bond market highlights from INR bonds. I'm Arjun Patsati. And on Friday, the US Treasury yield curve inverted, even as the government announced its huge borrowing program for the first half of the fiscal year 2022-23, where the government is borrowing 25% more than what it borrowed in the first half of last year. And with the RBI policy coming up this week, all eyes on the RBI to see how they will manage the US Fed rate hikes, the UST curve inversion, the high borrowing program, domestic inflation, and bond markets took up Gsec yields higher. 10-year Gsec yields went up almost 10 basis points to 6.90%, while the Sensex and Nifty also were higher, sharply higher on the HDFC and HDFC Bank merger announcement, which being index heavyweights, they took up the market sharply. The rupee also gained on expectations that there will be portfolio investments coming in through the merger as well. But the main highlights for the for last week and what the whole world is talking about is the U.S. Treasury yield curve inversion, where the 2-year UST yields are higher than the 10-year UST yields. And this came after a good jobs report for March, which saw unemployment at 3.6%. And the US economy added well over 400,000 jobs. All this is leading up to the US Treasury yield curve inversion, that two-year bond yields are higher than 10-year bond yields itself is an indication that markets are worried about recession. So why should this happen? Why should there be recession, etc., when the 2-year yields are higher than the 10-year yields? Now, there's a lot of theory behind this, but the main thing is that if US Fed hikes rates very sharply over the next couple of years, and with all the geopolitical risk, etc., this could lead to economic growth coming off, and there could be recession as well. Whether this is founded or unfounded, difficult remains to be seen. But that's what the markets are talking about, and that's what the market positioning also suggests. And with this, the last time the U.S. Treasury yield curve was inverted was just before the financial crisis in 2007-8, and which saw one of the biggest collapses in the market. So will this market? The main thing is what will happen. How is the US Treasury yield curve inversion impact the Gsec INR? Now, the main it's largely to do with risk aversion globally, and if there is talk of recession in the US, will there be capital outflows? And if there is capital outflows, the rupee can fall, and if the rupee falls, interest rates can rise. If RBI has to protect the rupee from falling sharply, and this can take up Gsec yields. Again, this is all in theory, and events can completely prove otherwise as well. But to attend my Twitter Spaces event on Thursday at 8 p.m. this week. Thursday is the 7th of April. Thursday, the 7th of April, 8 p.m., where we will be talking now. I'll be talking about the USD yield curve and its impact on Indian markets and how exactly the whole thing will work. And do look out for our webinar that will be announced shortly. This will be on Saturday, the 9th of April, on a masterclass in yield curves and what exactly does USD yield curve inversion mean, and how is the government Gsec yield curve looking against the USD yield curve, and where could it move, and what would be the opportunities available in the fixed income markets as we go along. Thank you very much for listening in. Do not forget to download our app, You Can Invest by INR Bonds, on iOS and Android, where you can invest in bonds seamlessly with the best bonds for your portfolio. giving you returns in an uncertain fixed income environment, generating and suiting your risk profile with the most information and transparency and the easiest of investment processes. Thank you.